Discussions in this show are for entertainment and educational purposes only and should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer and member of FINRA and SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and neither SmartPro Financial nor Bridgeway Wealth are affiliated. Hey, everybody. Welcome to the Working Wealth Podcast. I'm Patrick.
And I'm Haley.
And today we're going to be talking about what we believe are three of the most important metrics to track in your financial life. So,
to clarify, there are a lot. You could track.
There are definitely a lot of numbers you can track. And because of that, we wanted to break it down into really the three things that we look at the most in our personal lives, but also in terms of working with clients. Like what have we seen has led to what we consider to be the best results in people's financial lives as they prepare for the future, and then also focus on that transition into their ideal future financial state.
That's a great point.
So before we kick it off, though, Haley, do you have any thoughts that you want to share with the class about the metrics?
Yeah, I'd say the point is the metrics are a way that you can kind of give yourself a report card of today. And if you're not necessarily happy with the grade, you can change it. You know what I mean? I think it's that's what I'd say is, this is a great way to track. I think last night when we were talking about it, it's a barometer kind of where you are, and you can make changes to improve it if you want to.
Yeah. No, I love that. And really connecting this to the idea that, in every aspect of life, or at least in our culture growing up, we're assigned a grade, right? We're being told like, well, how well are we doing? What's our future look like, based on our current actions? Right. And that's probably one of the most common questions that I get from...
And boy, there's a lot of people looking at their returns and everything in this business, but this is something that you can kind of also control.
Yes, and that's a great point, is we want to focus on the things that we can actually have an impact on, rather than the things that we cannot control, right? Because you and I both don't know what's going to happen in the markets, right?
Correct.
I can tell you this, it'll go up, it'll go down. I can't tell you when, and I can't tell you by how much, right?
Yes, but to focus on that solely and to not focus on what you got going on in your household and your budgeting and what you're doing would be a big mistake.
Right. Yeah, because we want to make sure, again, we're focusing on the things we can control and influence, right? So diving right in, right? When we think about having those metrics, we're giving ourselves a grade or report card, like you said. I think this is one of the more common questions I have from people. And part of the reason why a lot of people reach out is just, hey, like, am I on track?
Yeah,
like, am I okay?
It's a great question.
Am I going to be okay? I have some clients that email me every 6 weeks. Are we okay?
Yeah, they're just trying to take their temperature.
They're trying to take their temperature. Right. Exactly. And that's why we wanted to do this episode, to break down, hey, like, what are the key things you need to be focused on, and specifically in every part of your financial journey, whether you're in the beginning phase or if you're in the ending phase, but things you can be cognizant of as we go forward.
Okay, so hit us with the three and then tell us what they are.
Yeah. So the first one, the one that we think is probably the more important one, is your net worth.
Okay.
So when we think about net worth is just a very, very simple calculation of taking everything you own and subtracting out everything you owe to somebody else. So we look at that as saying it's assets minus liabilities, right?
Liabilities being debts.
Liabilities being debts. Now, let's take a quick second, though, and let's define what assets are, or the common assets and the common debts, because I do have those conversations sometimes where people don't realize they have debt or that they have assets. Yeah. And we need to make sure we understand what that is, right?
Okay, what's an asset?
So an asset is something that you own of value. Ideally, it's something that can go up in value to increase your net worth. But a lot of times we have assets that go down in value, right?
Okay.
So a great example of an asset that goes down in value or can go down in value is a depreciating asset would be like your vehicle.
Okay, that's what I was thinking.
That could be clothes. That could be accessories. That could be household wares, things like that. Now, in all reality, when we calculate a net worth for someone, we're not usually adding those things in. Right. We're looking at like financial assets, bank accounts, retirement accounts, investments, real estate, business values, those kind of things. But the typical ones that can go up in value would be, your retirement accounts, your investments. If you have a closely held business, meaning it's your own small business. If you have your home, if you have investment properties, those kind of things all add positively or should add positively to your net worth.
Okay, so what's a liability?
So liabilities are anything that you owe to someone else. So very common ones for folks would be your primary mortgage.
Okay.
Could be a car loan.
Yeah, because you own your mortgage.
Yeah, because if you don't have a fully paid off mortgage, you don't own your home. You're a co-owner of your home with whatever bank you are financing your mortgage to, right? So we need to be very, very careful in understanding that, right?
So like credit cards.
Credit cards. This would be student loans. This
personal
would be
loans, HELOCs.
Personal loans, home equity lines of credit. This would be 401k loans if you've done those.
Okay.
Payday advances, medical bills, even though they're 0% interest, they are part of your liabilities.
Take out everything else you owe to everybody, and you're left with
a total value that is hopefully positive.
But it can be negative.
It can be negative.
And it can get better.
And it can get better. That's right. And it should get better, right? Like in our opinion, we should always be working to improve our net worth. There is a little sub element of that net worth though. We won't get too deep into it, but your liquid net worth versus your total net worth. Liquid net worth would be your accessible net worth. Like great example is we talk with a lot of folks that they bought their home 35 years ago and it was very, very inexpensive to buy it, and now it's worth $1 million. And they have $1 million home, but they
can't tap it. Because then they'd have to sell their home to be able to gain these resources.
Exactly.
Okay.
So if you'd have to do something to liquefy that real asset to be able to have the means to provide for your living needs.
That makes sense.
That is a big trap we're seeing with a lot of folks where they have a highly appreciated home that is paid off. Or it might not be paid off, but is typically paid off. Mm-hmm. But they only have $400,000 or $500,000 saved for retirement.
Right.
And that's even though your net worth might be say $1.5 million, you don't have enough liquidity to provide for your lifelong needs for future. So we want to make sure we're thinking about those things too.
So net worth is
net worth,
liabilities,
assets minus liabilities. Exactly.
Got it.
Yeah. So the second one we want to track is our burn rate.
Okay.
So burn rate. This is not I think there was a show called Burn Rate back in the day. No, Burn Notice is what I'm thinking of.
Yeah. It was a really good show.
I don't know.
I loved it.
I never watched it, but I saw the headlines for it.
Okay.
But so your burn rate is how much of our income that's coming in is going towards non-wealth producing activities. So this is what you spend on food. This is what you spend on your mortgage. This is what you spend on insurance. This is what you spend on clothing, fun activities, experiences, things like that.
So the majority of what I'm spending money on?
I hope not. I really hope not. But for a lot of people,
the categories most of the categories.
Right. So for a lot of people,
you're so funny.
The majority of their income is going towards burn liquidity, right? And we call it burn because it goes away, right? You light it on fire, it goes away. Now you're not literally lighting your income on fire.
I'm eating it.
But it's something
or wearing it.
You're eating it, you're wearing it, you're experiencing it, things like that. And that's not to say we don't want to say you shouldn't do those things. Obviously you should. You have to
I'm still
balance
laughing from you chastising me slightly.
Yeah, that's okay. That's okay. But you have to have that balance of enjoying life today while building and preserving generational wealth, right? That's part of our mission.
First episode, that's definitely what we're about.
Right, exactly.
Today and tomorrow.
But the biggest risk of that is a lot of people, especially our culture, our generation, I hear a lot of folks say, I don't want to invest because of XYZ reason, or, I don't want to do a budget because it feels restrictive, or, my parents had a bad experience with the market, so I'm scared to get in, or whatever the reason may be, right? If you're not being intentional and proactive to not spend all your money, then you most likely are not going to be prepared for the future, right?
Well, yeah.
And
you can't.
And it sounds so simple, right?
Well, it does. I
but the prevailing thought,
sitting here in this ivory castle. What do they call that?
Right, ivory tower.
Yeah,
right.
Talking about it. Yeah, of course. It seems so simple.
Right, and that's a whole other thing we can talk about of simple versus hard versus easy, that kind of stuff.
But
but in terms of the burn rate, right, is you have to understand that your income is your most powerful wealth building tool.
Okay.
Your income is what you're bringing in, right? Now, if you choose to spend it all and use it for experiences or buying things that dwindle and fade and rust over time, that kind of stuff, then you're not you're not necessarily going to be able to continue doing that as you get older, right? And this all goes back to everyone's personal situation is different, their desires are different, but if your focus is you want to be able to take a step back from work, make work optional, you want to, quote, retire down the road, right? Then you have to make sure you're allocating some of your income and some of your resources towards those opportunities. And for us, the way we primarily look at that is through saving and investing, right? You have to allocate some of your income towards things that will help produce or grow your wealth net worth
because
over
a common
time.
thing I hear being said is like, very rarely is someone okay with their standard of living going down in retirement.
Oh, I've had those conversations too many times. Right. And
but if you're not setting something aside, essentially you are saying that's what I'm going to be doing because that's what you're choosing, whether you know it or not.
Right. And you know the old adage of if you fail to plan, you plan to fail, right? And that's not to say there's not scenarios where people, hit it big or get lucky, those kind of things, right? We see those, occasionally. But the reality is, like, for most people, we have to be diligent of understanding, are we adequately preparing for the future? And I would say most people today, from my experience of having a lot of conversations, is they're not adequately preparing. So we want to help people change that. And I think that is a good lead into the third metric.
I was going to say, I know we've talked about, just to recap, we've got net worth. We've got burn rate.
And
then what's
the last one is the opposite of burn rate, which is your savings rate.
Okay.
So, or the complement, we'll say.
The thing that you want to make sure that I'm doing.
The thing that we want to encourage people are doing. Right,
so
exactly.
Funny.
So savings rate is how much of our income we're actually allocating towards wealth producing activities.
And I'm assuming, is it like there's so many different numbers out there. You should, about this much of your income should be going to retirement. What does that look like? Is that different for everybody?
So,
I'm assuming most likely it is, since that's normally your answer.
Yeah. So case by case for compliance, you have to evaluate everyone's individual situation and make determinations of, what is the right amount or what could be an opportunity to help people prepare for the future. But there are some benchmarks out there, right? And I would say that these benchmarks are becoming more and more standardized, even including some legislation that was passed at the end of 2022 with Secure Act 2.0. The government, Congress, has actually mandated that certain small businesses, if you have so many employees or more, you now have to offer, a retirement plan for your employees. And there has to be mandated, standardized minimum automatic contribution rates or like participation rates.
On the side of the employer or the side of the employee?
The employee.
Well, okay.
So for the past 10 to 15 years, we've seen that as like an offering that has like new retirement plans have just kind of been adding in like, oh, you start with our company, we'll put you in at 3%, right? 3% contributions into a 401k, things like that. But now there's legal backing for that. So, and it's all stuff you can change if like you don't want to do it or you want to increase it or decrease it. But there's a lot of push to make these things.
But it's defaulted to whatever.
We're going to
try and help you save some money.
Right. Isn't that funny? Isn't that interesting? Like, and again, this is more of like a cigar and bourbon kind of conversation of, thinking about the philosophy
this stuff gets me riled up.
of how things are changing in the government and with our laws in this country. But I think it's important to note is like, there is value to this. And this goes back to a conversation we had in our episode about IRAs and the basics there, where your employer-sponsored retirement plan is not necessarily a benefit out of the goodwill of your employer's heart, right? And that's, again, a whole lot more meat on that bone we can get into. Yeah. But going back to the savings rate, there are benchmark targets. One of the ones that we look at for a lot of folks is like, hey, can we get to maybe 15% of our gross income, right, that we can put away towards retirement and saving. And whatever the target is, if it's 15%, if it's 10%, if it's 20%, 25%, if you're part of the FIRE community, which is the financially independent retire early community, sometimes they say 40 to 60%, right? But ultimately, the key thing we want people to take away is you have to be doing something because if you're constantly living on the edge and you have no margin in your life, you can't navigate when things happen. You can't navigate when emergencies come up. If you're, most Americans today, like the number changes monthly, but it keeps getting higher and higher. I think the last number I saw was 72% of Americans can't cover a $500 emergency. like that's not a spot to be in. And that goes back to margin. So either increasing our income, reducing our expenses, allocating money to where we can be saving and investing is going to be important. But I want to just add one other thing to that is a lot of folks think, well, maybe 10 to 15% is high. Like it feels like a lot of my income. I would say no. Because if you think about that transition into your retirement years, like if you are going to traditionally retire, say at your full retirement age, which for most people today is close to 67 or 67 years old with the Social Security Administration, you have to think about the fact that if say you were investing or saving 15% of your income, you're living off the other 85%. Right? That means out of the other 85%, you're paying your health insurance, you're paying your car insurance, you're paying your mortgage, you're paying food, payments, things like that, whatever that may be. Well, when you transition into retirement, right, if you've been putting away 15% of your income, you're living off of 85, that means your standard of living, like it really doesn't have to change as much. Like a very common misnomer we have conversationally with folks is, well, I make $180,000 a year. I need $180,000 a year in income in retirement. No, you don't. No, you don't, right? Not necessarily, right? Because if you are saving and investing and you're accounting for taxes
and accumulation phase for retirement
to distribution or decumulation, right?
So then there's that 15% buffer where your life stays relatively
the same. It should, right?
Okay, here's a question that came up in my mind while I was talking. So these three things that we're talking about, people listening, they're all different types of people. People make different amounts of money. Mm-hmm. Do these three things ever change?
No.
Even if you are like, I don't know, you make minimum wage or you are $1 million earner a year?
I would say no. And there's a lot of studies that have shown over the years that once your household income crosses $70,000 per year, personal satisfaction from that extra income, dwindles. Everybody makes a joke of like, well, you can have more fun with more money. I get it, right? But the reality of the studies that have been done show that for most people, when they get over 70,000, there's not a substantial change in lifestyle, right? So I would say if your goal, like I'll go back and reframe the question, right? If your goal is to have a sustainable life, right? Like to be diligent, to put money away so you can like make work optional down the road to where you can like focus on family, focus on your hobbies and activities, then making these three metrics a priority today is going to only help increase your opportunity for success or opportunity for better results down the road. And I have to be careful about that word success because everybody defines it differently, right?
Right.
But thinking about what are the results you're looking for, the more intentional you can be with it, that's going to be the thing that we can use as a leverage point to make those things a reality, right? But just in recap, and I don't think we have to spend an hour talking about this. It's pretty straightforward. It's doing the work, right? Is number one is tracking your net worth, right? In years past, people thought the millionaire status was a big deal, right? And I think there's hundreds of thousands of millionaires today, right? The numbers are astounding. How many people are over that threshold from a net worth perspective, right? But tracking that and understanding what are the goals we want to aim for. That's going to be important. That's something that we look at, right? When we crossed 1 million, that was a big deal because it was like, hey, like we're here, right? But understanding also what assets play into that are important. If you have a small business, there's a value to that small business. Do you want to sell it? Are you just going to shut it down the road? Do you want to transition it? That carries value. Your home, your investments, cash, things like that. The burn rate, in my opinion, that's the one most people don't want to look at because it feels restrictive. But I can tell you right now with our budget, and I'd love your opinion on this.
Okay.
I feel a lot more freedom to know where I can spend because we are saving and investing and allocating money towards other things for our future.
Well, because we have it so dialed in.
Right.
I know when I do or when I don't have the ability to do something.
And I'll just say, like to add to that, if you don't have it dialed in today, just start somewhere.
Correct.
Like the first thing you can do is write down your income. The next thing you do
is... You're not going to get it right the first time.
Oh, and it changes every day.
And it's really not supposed to be right the first time?
Right. And anytime you have a major life change, the numbers are going to change.
And it's going to change again.
Right. But continuing that process of just doing like a check of like, hey, where am I at? Right. And, I love the idea of tracking every dollar because that gives me personal satisfaction for the nerd in my brain.
Of course.
But not everybody has to do that. Right. You can be more You can make quicker progress, in my opinion. I've seen it from a lot of people. If you do track every dollar and you give every dollar a name, but if you go with zones or you look at categories, you just say this much in this category, this much in that category. If you automate your saving and investing, that's a way you can help navigate that burn rate discussion better.
Great.
But all that said, I think that those are the three things to focus on: is that net worth, the burn rate, and savings rate. And if you do those three things and you're consistent with it, tracking those, measuring them, monitoring them, from our experience personally and seeing hundreds of people do that, that can lead to a tremendous amount of opportunity down the road. So,
Well, great. Well, thanks for those great little bits of advice and, just things to be thinking about. And thank you guys for joining us again for this episode 3. And we are looking forward to catching up with you next time.
yeah, have a great day. Thanks so much. Discussions in this show are for entertainment and educational purposes only and should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through registered representatives of Cambridge Investment Research, Inc., a broker-dealer and member of FINRA and SIPC. Advisory services through Cambridge Investment Research Advisors, Inc., a registered investment advisor. Cambridge and neither SmartPro Financial nor Bridgeway Wealth are affiliated.